Surface Financial, and it's time for your Monday mortgage update for the week of February the 14th. It's Monday and it is Valentine's Day. Love is in the air. Hope everybody has a wonderful weekend, and don't let Monday get in the way of love, and appreciate and love on your significant other. So what happened last week and what's going to happen this week? So last week, really big sell-off. The market lost 84 basis points. And so basically when the mortgage market goes down, money's flowing out of that market and mortgage rates go up. Pretty straightforward. And so we saw an 84 basis point dump from Monday to Friday, and rates went up. So let's look at the charts, and I want to give you a visual and really what that looks like. So this is a snapshot of the trading of mortgage-backed securities. Each one of these bars represents 1 day of trading. And when we see the green bars, that means money's flowing into the bond market, as an example, and mortgage rates are getting better. When we see the red bars, money's flowing out, mortgage rates are getting worse. So this chart goes all the way back to August of last year, and I could take it back even longer, but basically we see that it's been pretty flat for a while. But everything changed, as I've been talking about, in November of last year. And this is really when we started to see those mortgage rates go up, because the Fed announced that they're going to stop buying mortgage-backed securities, getting out of the bond market. They were going to do it in the summer, then they accelerated that, and they decided, you know what, we can't wait till the summer. We're actually going to do it much sooner than that. And this has really been the trend since November of last year. A big exit of money out of the bond market, causing those mortgage rates to go up. And the biggest reason for this, we know, is inflation. The Fed's going to hike mortgage rates. In 2.5 weeks, they're going to stop buying mortgage-backed securities. So you can also see what happened just on Thursday. 114 basis point dump in the market. Rates shot way up. And then we had a little recovery last week on Friday. Why? Because the White House announced that Russia was going to invade Ukraine, and that it was imminent, and that it was going to happen anytime. And so anytime there's geopolitical disruptions or big concerns about something like that, there's a flight to safety and money flows into that bond market, and that helps mortgage rates. But then today, everybody calmed down a little bit, and Putin came out and said, you know what, we need to talk a little bit more. We're really not going to invade. Even though who knows if they were going to, but that's what the White House said. So that's why we got this big volatility. So what's happening this week? What's going to affect rates in the market this week? Number one is Russia, geopolitical. Number two is the Fed speaking, giving their insight on what happened at the meeting a couple weeks ago. And number three, recession. Is recession in the air, just like love is? So let's talk about Russia. You know, everything that we're seeing in the market right now absolutely points to higher rates. Nothing is indicating that we're going to see better pricing, except one albatross, one unicorn, and that's if Russia really dumps into Ukraine and invades Ukraine. And if they do that, as we saw on Friday, there's going to be a flight to safety. Not just our 401ks, but foreign investors are going to put their money in our bond market, and that'll be favorable for mortgage rates. But that's a big if. You know, we can hate on Russia, but it doesn't mean they're going to invade Ukraine just because we don't like them. So that really is the only thing that could move rates. And right now, Russia has said, hey, we want to talk. And so there's really no imminent threat right now. So the second thing is the Fed. They're going to come out with, a lot of the Fed members come out with their insight on where they think the market's going. Rate hikes, so we'd rate hike half a point in March. Some people are saying maybe a full percentage by the summer. So those rate hikes, again, are the main fighter of inflation. We've got to fight inflation. Last week, the CPI came out. Inflation is now at a 40-year high. It's the highest we've ever seen it in 40 years. This is not good. Everything costs more, and this is going to absolutely have an impact on what people spend. It's going to have an impact on pricing. It's going to have an impact maybe on home values. It is not going away, and the Fed has to get really aggressive on hiking that rate. And so really, what are those Fed members going to say? And then the last thing is a recession. We've been talking about this. There's some indicators that a recession is coming. We always know a recession is going to hit the U.S. economy. And so what the Fed's doing as far as hiking those short-term rates or those Fed rates, that is how they're going to fight inflation. But the primary way they fight a recession is to lower the rates. So right now, that Fed rate is at 0, they got to hike it to lower it. So they've really put themselves in a tough situation. And I want to go back to a chart here and show you really some indication that maybe we are headed into a recession. So anytime there's an inverted yield curve, meaning that the short-term bond is or yield is higher than the long-term. Typically shorter-term rates, shorter-term yields give lower rates. But anytime that's inverted, and so we start to see the short-term higher, it's always been followed by a recession. And so this shows an inverted yield curve. Anytime there's an inverted yield curve, it gets down to 0 here, we see this recessionary numbers. And this red really, if you look back in history, these red areas are the recessions we've had in the past. And we're starting to see some indications that we're approaching this inverted yield curve right now. And it's something to be aware of. Now, experts say we could be 12, 18 months away from a recession. Obviously, a lot of things have to happen, but it's really interesting to watch history repeat itself. So what are we looking at this week? We're locking. As I announced a couple weeks ago, I'm not advising my clients to float a rate. We're just in more of a downward position as far as the pricing, which means rates will go up. We expect a calm day today with some volatility starting on Wednesday. So locking is really the rule of the week. And then we'll see what happens on Friday when we've got PPI coming out, another major indicator of inflation. So hope you have a wonderful week. If you know anybody that can benefit from this video, please forward it to them. If you need any insight on rates, please give me a call. Hope you have a wonderful, productive week. We'll talk to you soon. Bye-bye.